Hello, everyone. Welcome back. This is your host, Dave Keller. Thanks for joining us, as always, on the Final Bar. Really appreciate you tuning in. I want to welcome my guest, Tom McClellan from McClellan Financial Publications. Tom, thanks so much for joining us on the show today. We appreciate it.
It's great to be with you, and I welcome you again to the Pacific Northwest. It's nice that you've moved out here with us.
So far, we've had plenty of rain now. I'm getting used to that. We're getting some good cold here, so I'm enjoying it. It's a good fall experience so far. Not too bad.
Okay.
You sent 3 charts ahead of time. We really appreciate it, Tom. And the first one is looking at the S&P versus emerging markets. I'm really interested to hear what this is telling you.
Well, this chart was a subject of my weekly Chart in Focus email series. It's a once-a-week article on whatever I feel like talking about that's of interest or that's happening right now. This is useful because EEM, the big emerging markets ETF, generally moves along in step with the stock market, but occasionally the two of them will disagree. And it's when they disagree that you get useful information. Usually that's in the form of a divergence, like some of the ones I've labeled in this chart. In this case, the disagreement was that EEM broke its downtrend line ahead of the same line being broken on the S&P 500. We saw that same behavior coming out of the December 2018 low, where EEM broke its trend line first, and then the S&P 500 followed suit later on. So we're seeing that now. This is showing strength. And the reason why this is important and matters is that EEM, the stocks that make it up, they are incredibly sensitive to financial market liquidity. So they're like the canaries in the coal mine that'll die before the coal miners will. And when you see it starting to suffer, or when you see it starting to do better, that is a tell for the state of the liquidity stream. And right now it's saying liquidity is really strong. I should note that this chart is not quite up to date. It's current as of Thursday. It doesn't have Friday's data in it, and the EEM is up another 1.5% to a higher high. S&P is up to a higher high. So one thing, whenever you look at a chart like this, especially in an article from earlier this week, you got to kind of mentally draw in the most recent data. If you go to the next chart, there's more insight about EEM. As an exchange-traded fund, the number of shares in the fund can change, and it does all the time. It goes up and goes down as more people want to own it. The sponsoring firm has to issue or redeem shares, and they either buy the underlying or they sell the underlying to keep the net asset value and the share price real close together. EEM has broken its trend line. It's busting out to higher highs, but so far there's no investor interest showing back up in it. The number of shares outstanding is remaining constant. And that's a tell that says the public is not yet buying into this. At the point when we see shares outstanding starting to rise rapidly, then you know that the game is almost at the end. You can track this data. You can download a historical series. You just go to the iShares website and pull up the page for EEM, and then there's a download link that gets you a spreadsheet for it. So right now it's saying this is still early. Everybody's still asleep. Nobody's caught on yet. The EEM is starting to act strong.
Very interesting. And then just before we were coming on, we were talking, you shared this third chart, which is looking at the traditional version of the McClellan Oscillator, which I know you're clearly very familiar with. Can you just very quickly, how do we think of this and what is it telling you right now?
Well, this is the indicator that my parents created 50 years ago, back in 1969. And I want to point out again, this chart is not up to date. It's missing Friday's data because you guys are going to wait until you get the final breadth data posted into your database. So this is showing what happened through Thursday. We had a little minor dip below zero, to just barely below zero. Crossing below the zero line can be a negative indication. And it stopped me out yesterday, but I'm back in today because it's bursted back up through zero, up to around plus 50 on a preliminary basis. When it does that, when the oscillator does that, dipping just barely below zero and then popping back up above, that's what the late Kennedy Gammons used to call a buy spike, except he was from Tennessee, so he called it a buy spike. And it's a very, very bullish indication because it says the bears had a chance. They took it below zero. The bears had the chance to try to get some yardage, and they turned around and failed. And so it's a great low risk entry point. It says that there should be more up to speed, more higher movement in the days ahead. And I want to say one last thing about making sure charts are up to date. You were showing some charts earlier in the segment about new highs. And again, that's end of day data. And it's even at 1 o'clock, which is the Pacific time, which is the end of day, or 4 o'clock Eastern, the end of day data is not always up to date. So the New York Stock Exchange new highs looked like they were making a divergence, but that got rehabilitated and that chart's off the Group W bench. and there's 181 new highs on the NYSE today. So that divergence that looked like it was there now goes away.
You know, and it's interesting. There are a lot of parallels between this chart we're showing now and the chart you just mentioned that I showed earlier with that potential divergence. And I think that's maybe what we've both seen. Right? You felt some potential internal weakness, but boy, if you think of today as the last thing we've seen, both of those things feel like they've sort of resolved higher, I guess, right? What I'd love to go back just thinking about that first chart you showed us, which was the S&P versus EEM. When you've always done a great job of sort of showing these historical patterns, how they relate to previous breaks. I'm curious with a chart like this, at what point would you think maybe it was incorrect or think that the bullish call here was wrong, didn't work out? Would it be a change of that pattern of the divergences that maybe did not play out, or would it just be EM or the S&P are both breaking through support? Or how would you kind of think of it from using this chart?
Great question. And as a former pilot, you think like a pilot. You're always thinking, when my engine quits in the next 5 seconds, where am I going to?
Exactly right.
You're always thinking that, even throughout the entire 3-hour flight. You're always looking for where's your emergency landing zone. If this chart were to suddenly show a divergence appearing, like the other ones that I highlighted in red, where EEM makes a lower high, which it's not doing, and the S&P makes a higher high, that would be a problem. It could fail on its own. If they could both drop back below their broken downtrend lines, and that would be another mode of failure. We're not seeing that yet. For now, it's still looking bullish. And I want to also emphasize EEM is still below highs it made earlier in 19 and still below highs made in 18. And so some might say, well, that's a big long-term divergence. That's not the time frame over which these divergences tend to matter. You need to focus in on just divergences that are maybe 2 to 5 weeks in duration, because that seems to be the sweet spot in terms of how they matter. Stuff that's long ago in the past, a year and a half ago, you can forget about that in terms of the message that you're going to get from this indication.
Got it. Tom, listen, thanks so much. Stay warm, stay dry. Thank you for sharing 3 charts with us. We'll hope to have you back on again soon, all right?
Nice to be with you.